Hey everyone, in this video, like I've done in the past, I just want to take some time at the beginning of the week to go through all of the key earnings reports that we have coming up this week. It's a super busy week of earnings, so this should be a good video, a fun week for the markets as well. But before jumping into this and before kind of going stock to stock, looking at some earnings per share forecasts and my thoughts about some of these stocks and what ones I'm watching, if you could just take a minute to subscribe to the channel if you haven't yet, and also like the video. It really does help with the YouTube algorithm for everyone who hits the thumbs up button. So just giving you a second to do that before getting into it. We're going to start on Monday. There's lots going on Monday. Just going through, we have Avis Budget Group, Global Payments, obviously SOFI and MGM at the top, Norwegian Cruise Line. The ones that I'm going to be peeking at on Monday is SOFI, which is a fintech company, as well as MGM Resorts. Getting into those two stocks a bit, SoFi is a company that really strived during the pandemic with low interest rates. Yeah, I think it launched as a SPAC. I guess we'll take a look here. December of 2020. So right during the market exploding. Since then, it launched at $10 a share. We're down to $6, so it's down 40%. Not great performance. They've had a string of bad luck in terms of government mandates against students paying student loans and stuff like that, which is a really core part of their business. But over the last 1 year, they've stabilized nicely. They've been about flat overall. This is about a $6 billion company. I really do like how they talk about their business. They seem to really know what they're doing. I've listened to one or two of their earnings calls before. But at the end of the day, they're in very challenging categories for banks in terms of who they lend to and the types of loans that they lend out. And they haven't been able to be profitable thus far, even just going down here and looking. While it does look like they are quarter over quarter glide pathing closer to profitability, there's so many options in banking that are such low price to earnings multiple. You get such a quick return on investment through dividend share buybacks, acquisitions. So it's a really competitive space to win investors, in my opinion, because of that competition. Looking at their earnings per share projections, so on the current year, they're projected to lose about 20 cents a share, and then next year they're essentially projected to break even to slightly profitable. So in the environment we're in today with interest rates at like 5-6%, having a company that's going to lose money this year and then be break even next year, if I just invested in a company that's trading at 10 times earnings, I'm going to get 20% of my capital back in one way or another in the next 2 years, whereas this company is going to be negative on capital return over that time period in terms of return on invested capital. So that's just some of the challenges I have with a name like SoFi Technologies. Really looking forward to seeing what they report, how the stock reacts, but personally, not one that I'm interested in this environment. The second stock was MGM, and I'm not even sure if I have MGM open, but MGM stock here has been doing really well. MGM up over the last 1 year, 7%, last 5 years up over 40%, despite obviously everything that's impacted their business from a pandemic perspective. Looks like you're trading at about 13 times earnings. It'll just be really interesting. Obviously, this company has choppy earnings given the nature of their business. It'll be really interesting to see some of the narrative that they put out there just in terms of the gambling space and the overall consumer, how they're doing, if they're seeing any slowdowns, and so on and so forth. So really looking forward to that earnings call as well. Going on to Tuesday, there's a handful of them on Tuesday that I'm really interested in. The first one is Uber, obviously ride-sharing company. We'll see how this company is doing both on their rides division and their eats division. The company has been trading in the same spot for years and years, essentially, between like 25 and $40. Really hasn't broken out. It goes up, then it goes back down within that range. So we'll see if it could really start to string some momentum together. The second one is Pfizer. Pfizer has had a tough year as they've kind of anniversaried the big spike in their revenues and profits behind the COVID vaccine. So we'll see what their trajection's like and their profitability. But I think this one's trading at a pretty low price to earnings multiple. Obviously a pharmaceutical company as well. So depending on when their patents expire and other things, there could be more to it than that. But looking forward to learning more on Tuesday. We'll talk about that stock in a minute as well. Marriott is one in the travel space I'm interested in. You got Starbucks here, which has just been on a complete tear recently, so interested to see how that stock reacts, and then Match Group as well. So those are the ones I'm focused on. I think Tuesday is probably the busiest day in the market. We'll start here with Uber. So Uber currently trading at 31 bucks a share, $62 billion valuation. If we just go down here, kind of see they slightly made money last quarter. Before that, they were primarily negative, but you had like a quarter here and there where they were positive. They haven't really made meaningful amounts of money. They made $1 billion, I guess, in 2018, but since then they've been losing $8.5 billion, $7 billion, essentially break even, and then last year lost $9 billion. So it will be interesting to see if they can continue to pump out free cash flows, what the rates of growth on eats versus rides are, and so on and so forth. Looking at analyst expectations on Uber. So this is what is tough on my end here. That similar to SOFI that we just recently talked, even on the year, they're estimated to lose about a dime, so break even, let's call it. And next year, some analysts have them losing money, other ones have them making money. Average analyst has them making about 60 cents a share. So that's an earnings per share. Oh, wrong one there. But that's an earnings per share in the mid 40s. So expensive valuation on this one. If you just do it from a price to earnings multiple, hopefully they can drive scale and exponential growth of profitability. But given, this company is definitely not a new company, so they've had time to do that and they haven't done it yet. So I'm a bit skeptical in their ability to really like double that net income year over year or something like that. So love the business, especially the rides business. So won't pass any judgment in terms of valuation until I see the report. But from a far way away, it does look like it's trading at an expensive forward multiple, especially since they haven't been able to execute over on like a profitable, consistently profitable strategy over anything past a quarter at a time. So not sure if they'll truly hit like the high side estimates here, which would have the company trading closer to a mid 20 multiple for 2024. The next stop we got here is Starbucks. So Starbucks, if you just let my computer load here. Oh, there we go. Starbucks has really ripped in the last year. We're up over 50%. This company's back up to $130 billion behemoth. Huge price to earnings ratio on this one. Looking into what is projected for earnings per share, it's about $3.50 this year, $4 next year. So if I just take $3.50 times it by 30, let's call it, it would get me at 105. So this company's trading at about a 34 forward multiple. No thank you on my end in terms of paying a 34 current year multiple and then also like a 29 next year multiple for a premium coffee business. So this one, in my opinion, is just way too overvalued. I actually had this on my watch list when it went down to about like $70 a share, low 70s. Obviously, hindsight's 2020, should have picked some up. But I thought that could be an attractive entry point. I think it was closer to 20 times earnings, high teens, which was more in line with what some of the other QSR companies were at that time. But this one's just really knocked them out of the park, rebounded back to their lofty valuation since then. So this is one that I'll probably stay away from. I think there's probably a lot more downside versus upside in their valuation in terms of risk going into earnings. So we'll see how that plays out. But I'm kind of just on the sidelines on this one. Interested in watching what's going on, but not really one that I'm overly interested in adding to my portfolio. And then Pfizer. So Pfizer has been an interesting one. It's down 20% on the year. It says it's trading at a 7 times price to earnings. Not 100% sure if that's accurate, but it wouldn't shock me on these kinds of businesses that have patents expiring and other things going on that may cause them to trade at very low discounts in terms of the trailing multiple. Because there is a lot of volatility year to year. So maybe the forecast for next year is lower. We'll look at that in a second. This company is a $220 billion company, has a dividend yield over 4%, which is really nice. Looking at their estimated earnings here. We have them at about $3.30 this year, $3.70 next year. So they actually are expecting some pretty nice growth, but they're trading at about 12 times current earnings, 10 to 11 times future earnings. Like, I think that, once again, from far away here, because I haven't done a deep dive on this company in a while, but that seems like a good valuation for a company like this. Trading low teens multiple, you have some great products that they sell. They also own, I think, an equity stake in some consumer brands as well. They're paying you a nice dividend. I believe they buy back lots of shares. They have an innovation pipeline. So this is actually one I'm going to add to my watch list and maybe do some more research on it this week, either leading into earnings or on their earnings report. But this is one that's going this week that I'm actually more and more interested in. They're about 1.5% off their 52-week low. So I'm going to try to understand what's going on with this company more, and if they truly have a multi-year expectation of trading, at 10, 11 times earnings, or continuing to pump out $3.50 a share in earnings per share over the medium term. This could be a good one for me to add to my portfolio. So this is one that I am interested in this week in terms of a potential add. And then the last one, I think, one of the last ones on Tuesday, Match Group. Match Group has gotten hit hard since COVID. You see here down 55% just in the last year, down 62% in the last 5. But if I just take the peak here, 169, they're down 80%. So this company owns lots of dating apps like Tinder, Hinge, obviously Match.ca. I think they own Plenty of Fish. Currently trading at $10 billion, saying it's a 30 times PE. Looking at their earnings per share here, $2 this year, $2 and change. So they're trading at about 18 times current year earnings, which is actually pretty good for a business like this, tech company. In terms of future earnings, they're trading closer to 15, 16 times. So this is another one that I may take a closer look at. Similar to Pfizer, it seems like it's trading at a fair current and future multiple in an interesting business or category rather. So this is one at a $10 billion market cap that I may want to take a closer look at. Just looking at annual revenues and profits. I like the way this looks. I'm not sure what's happened the last few years, not sure why it's not up, but you can kind of see it's been consistently profitable on net income, growing revenues year over year. So this looks like an interesting company to keep on my watch list for this week as well. Going into Wednesday, and before I talk Wednesday, InMode is actually another company that I'm interested in. I didn't know it was reporting this week. I just saw that now live. But that's a company that supplies med spas with lots of equipment to do procedures and stuff. So that's a really interesting business. Sorry for my cough. I still have a bit of a cough from a prior head cold I had. But InMode's another one I'll definitely be watching on Tuesday. Going into Wednesday, probably the second most exciting day of earnings this week. You got CVS Health reporting. It's really interesting to see, given all the shrink and the theft going on in the U.S. and in drugstores, what they have to say about that, how much that's impacted their business. Also on the pharmaceutical side, there's been lots of competition from big companies in healthcare. They're making a really big push there, so it'll be interesting to see if that's panning out, if they're growing there, if it's not economical as they once thought. So interested to see what they say there. On Yum Brands, I have lots of quick service restaurant companies, so that's one I'll definitely take a look at, even though I don't own it. WWE just merged with Endeavor, so you may get some more information there on that call in terms of what timing's going to look like, what that new company's going to look like. Estee Lauder, super successful beauty company, some of the highest return on equity and return on invested capital ratios in the entire market. So that one's interesting as well. Looking at a couple of these names, just going into the Wednesday stocks here, CVS Health, trading close to a 52-week low as well, about 2% off, currently paying a 3.3% dividend. In the last year, this one's gotten crushed down 25%. And even longer term, up 10-15% over 5 years isn't really anything to write home about. In terms of earnings per share forecast, they look like they're going to do just under $9 this year, similar amount next year. So this company's trading for about 8 times earnings, which is pretty wild. But that's pretty similar if you look across probably their main competitor being Walgreens. Both these companies are trading at very low earnings multiples. So interesting to see that. I have Walgreens on my watch list. Maybe I should, look at CVS as well. What one I find more attractive, but I do like dividend that Walgreens gives to shareholders. So that's why that one's on my watch list there. Yum Brands here, a bit of a different story. This one's been running up. You see it up over 20% in the last year, sitting essentially, or it literally hit a 52-week high on Friday going into earnings. Looks like trailing 31 times earnings multiple, paying just under 2% dividend yield. If I look to their current earning forecast, it's just over $5 a share. Next year, it's closer to $6 a share. So even this year, at $5 a share, it's trading at about 28 times current year earnings. Expensive stock for this kind of business. So this is definitely one that I definitely have exposure to the space. Like I own McDonald's, which has a similar multiple. But if I was going to own a company at a high 20 multiple in the QSR space, it would be McDonald's over Yum Brands. So I'm comfortable with my exposure to the space. Yum Brands is, I'm sure, a great company too, but I just don't want too much exposure to these companies at, high 20, 30 times earnings multiples. I think it's definitely on the high side of the valuation structure. But these are defensive businesses. That is why they're warranting those kinds of valuations. I just want to make sure it's the right size in terms of the position in my portfolio for companies that could have some value contraction or price to earnings contraction risk in their business or in their valuation. So that's kind of my thoughts on that one. And one stock that I skipped over quick from Tuesday was Marriott. So Marriott has been doing pretty well over the last year. Just to take a look, it's down 5%, but you can kind of see we're on the kind of middle to high side of the 52-week range. $50 billion company, currently trading 24 times. You only get a 1% dividend on this one. Looking at the earnings per share forecast here, it's about $7.75 and then 10% growth for next year. So as I look at that, yeah, they're trading right in that like 23 and a half-ish earnings multiple for this year. And then that'll go down to about 21 times for 2024. So hopefully travel keeps pumping, keeps booming. I'm really interested in what Marriott does just because I do own shares of Disney. I've been in and out of Airbnb. I'm interested in getting even more exposure to the hospitality space. I'm looking at a couple other companies that I'll talk about on other videos. So I just find it interesting to get a read of what Marriott is doing and how they're performing from an operational standpoint during their earnings call this week, just given how much of a behemoth they are in this space. Going into Thursday. So Thursday, we got some big names too. You got AB InBev, which is world's biggest beer company, I believe. Apple, biggest, most important company in the world in terms of earnings. So many other stocks rely or move based off of what Apple does and says. Shopify is another big e-commerce company, so that'll be interesting. Block has lots going on too. Some companies that are reporting, but I'm not going to talk about in much depth. Peloton, I know they've been trying to sell themselves for like a year now, so it'd be interesting if they give an update on that. Royal Caribbean, they report on Thursday. One of their competitors, Norwegian, reports on Monday, so it'll be interesting to see if any deltas. Coinbase, I feel like, is in the news all the time, but generally the stock's just been, I think it's been ripping lately, but overall, just not one I'm interested in. Seems very speculative. DraftKings will be interesting to see if they're any closer to profitability. Lyft has just gotten destroyed lately, so we'll see if they say anything to get themselves out of that. You got other businesses that I thought were bankrupt, like Carvana, so I guess they're still reporting nowadays. And then businesses like Shell, Booking Holdings, I may look at top line too for the same reason as I was interested in Marriott. But yeah, super busy day. Some of the ones that I'm looking at a bit more are Apple for the first part. I think everyone who owns individual stocks, or even if you just own ETFs, Apple is such an important company. They can move the entire stock market up or down. It's really done great over the last couple months. You see, you see here even since January. So if I go year to date, you're probably up. Yeah, wow, year to date up 35%. I can't explain how insane this is for $2.7 trillion company to go up 35% in 4 months. That's literally like $1 trillion of value being swung on the biggest company in the world. That's not really supposed to be a high flying company necessarily, relatively stable, developed revenue streams. So on Apple, I'll really be looking to see how their service revenue has either accelerated or decelerated. Any comments on them breaking into new product category spaces? I know they've talked about like VR headsets, stuff like that, or any new innovations that are coming down the pipe, and what their buybacks looking like. Just lots of stuff like that I'll be interested in seeing. In terms of a look at their earnings estimate, it's really about $6 a share, and then up 10% for 2024. So at $6 a share, they're trading right about 28 times, and then I guess next year would be 26 times. You know, for a company that also has a ton of hardware exposure, like laptops, I guess iPhones are a bit more defensive because everyone eventually needs them. And then a big chunk of their business and supply chain in China. I think 28, 29 times for a company like this is, I'm just not willing to pay it. So I think it's a great business. Probably do well long term with it, but I just can't bite the bullet on that one with other opportunities there are in the market today. So this is one that I'm personally not buying, but just for the general sake of the overall market, I do hope they do well. Going into Shopify. So Shopify's been on a wild ride. They're up 250% over the last 5 years, but included in that is a 70% drop. So they were up closer to 1,000%, and they gave about 3/4 of it up. Still over a $60 billion company. For those of you who don't know, this is a e-commerce company. They have e-commerce platforms for businesses of all sizes. They're also moving in the store with lots of devices like Block has to enable payment processing, and they also provide capital. They're really in a lot of different segments of the small medium business ecosystem. Looking at their EPS forecast here, this is another one that I just struggle with. Like, such a great business, growing so fast, great business model, expanding in all ways. But with that being said, they're going to break even this year, and for all intensive purposes, next year as well. There's just so many stocks that I can be getting 5-10% return on invested, like in return on my investment back through buybacks and dividends in a year, that it's hard to give up 2-3 years to count on the growth to eventually turn into strong earnings per share. So I tend to lean on the companies that I can see a path to returning my capital quicker for the most part. Maybe one or two of these companies as more of like a spec inclusion would make sense in my portfolio, but just me personally and how I tend to manage my portfolio right now, not really interested in the name just because of the valuation and their earnings per share outlook, despite it being a fantastic business. The next one I have here is Block, $36 billion. This one's come down huge, as all the companies in this fintech space has. So it's down about 80% off its highs. I hated the acquisition they did of Afterpay, diluted their shareholders 30% to add in a non-profitable business that had like no line of sight, the unit economics making sense. So I was honestly debating buying Block around, I think it was probably $100 a share or whatever. I just loved the business. It was going to be one of the companies that I just put in as more of like a spec play and hold it for the long term. And then I just really hated that Afterpay deal, so I never ended up buying the company. So that ended up working out well for me, given where the company's gone since then. In terms of earnings per share forecast, they're actually projected to be profitable. So that was one of the reasons that I did like the company even before the Afterpay buy. But they're going to make, let's call it a couple bucks of earnings per share. So they're trading like 30 times earnings. Honestly, I wasn't expecting it to be that reasonable. So I'm surprised to see that. Hopefully those numbers actually come in. I'll be keeping an eye on it to see if they do. And maybe, hey, if they actually provide guidance for like a multiple under 30 times, and I like what they're doing on the business. Maybe I'll add it to my watch list. And the last company that I'm watching that's reporting Friday. On Friday, there's a couple. You have International Seaways, you have Enbridge, which is a huge energy company in North America. But the one that I'm really going to be watching is Warner Bros. Discovery. I do own shares of Disney. I am just genuinely interested in like the media space. This company year to date's up 43%, but it's really dipped recently, down about 10% over the last month or so. So this company is just riddled with debt, has like 40 billion plus of debt, has been missing all of their EBITDA targets based off of like a weak ad market, in addition to cost of capital going up and them having to service that 40 billion in debt. So this is a company that's like I feel like they have the potential to go up like 100% if the ad market really turned around. They pay down their debt aggressively. Their new streaming service really took off. Like they have the opportunity to fire on all cylinders, but it could also go the other way where they're not able to reinvest in their business enough because they have to service that debt, and they fall more and more behind on streaming, on cable, on innovation, on new shows. So this is one that is a bit too much of a gamble for me, and I'd just rather put my money into some of my other entertainment companies, whether that's Disney or whether that's starting a new position in more of a travel or hospitality company. I'd rather invest my dollars there in terms of experience and entertainment more so than roll the dice on Warner Brothers Discovery. But hey, I could honestly see the stock moving 10 to 20% up or down after earnings on Friday. So it'll be exciting to see what happens on this one. So those are some of my thoughts on the earnings that are coming up this week. Would love to hear your thoughts in the comments. Let me know if you own any of these stocks, if you're looking forward to any of these earnings. Let me know what your thoughts are on the companies that I'll be specifically watching to potentially invest in. I'd say the number one that is probably my highest or the one I'm closest to seriously considering is Pfizer, mainly because that low price to earnings ratio, and they also are a big business, global presence, have a lot of big brands, and provide a lot of services and products that people need. So that's one that I think will do well in many different types of environments. So we'll be sure to keep that one on the watch list, especially with that dividend approaching 4.5%. Let me know if you stayed all the way through this video. Most people don't watch the entire video, so I'd love to hear from you in the comments if you made it all the way through. And if you haven't yet, be sure to like the video. It really helps the channel. Subscribe to the channel. I'd love that a lot. And I'll see you guys in the next one. Thanks.